Hope everyone is well. Just getting the morning briefing underway, and a couple of things to cover off before I get into the charts and discuss what I'm looking at in terms of today to mark, or this week, a historical anniversary. It is, of course, given if you walked outside around lunchtime yesterday, you might have thought it's the beginning of the end. Well, it just so happens that this week is the anniversary of the 1987 stock market crash. Anyone, I know I've talked to some of you about this already, so maybe the guys in stage one, can you tell me what percent the Dow fell in one day in the stock market crash of 1987? Answers in the chat room, please. What was the percent of the decline in the Dow in the stock market crash one day? Don't all flood me with answers at once. Anyone want to have a guess?
50%.
Okay, we got a number on the board. 50%. Anyone else? 33%. Okay, 33 to 50.
33.
Okay, not sure if my chat is actually updating because I've got 0 guesses here in the chat room so far. So I will tell you, 22%. 22%. So the equivalent of more than a 5,000 point drop, if you were to put it into today's equivalent. So looking at this, I did send this out to you. I just wanted to point it out really for, well, let's just have a look at some of the charts and then I'll tell you some things that I think about this particular connection that a lot of people will make given the historic kind of timing relevance that it's the 30th anniversary, of course, since this happened. And one is, a lot of people will be floating around charts mapping that of something like this. The performance of the blue line being right now and the yellow line being the stock market crash of 1987. And as you can see, if you were looking at it on this metric, and I've seen quite a few of these this morning already, they're mapping each other fairly well in terms of the performance. If you start breaking it down though and looking a little bit closer between the actual period in the 2-year run-in to the actual stock market collapse, you might think, well, it's a pretty incredible rally that we've been seeing in regards to the S&P, particularly post-Donald Trump and this whole kind of Trump trade. But just check out the 1985 to 1987 performance of the S&P. You thought the rise that we've seen was pretty steep, with around 20% returns. Well, back in 87, between 85 and 87, we had over 100% rise in the S&P at that point. And so obviously you can see the severity of the collapse that we had on that particular single day and thereafter. Now, an interesting point here, because when we look at these sorts of charts in terms of price movements and patterns, you see you can draw some similarities, but one of the important things here, and I really like the way that this document has summed it up, which is the fundamental comparison. Technically, fine, they look fairly similar, but fundamentally, really, it couldn't be any more different between now and then. A couple of things here that they're looking at, just to quickly skim over. Again, this document is in your inbox, but looking at tighter monetary policy. If you remember back, well, if any of you who were around at that point interested in financial markets, it was Alan Greenspan had just replaced Paul Volcker as the chairman of the Fed and had just raised the Fed's discount rate in September of 87. Obviously the crash happened a few weeks after. If you think about, we're in a tightening cycle now, but the Fed has been very gradual and transparent, and rates remain relatively stimulative, i.e. still very close to these historically low levels. The other thing is the US dollar collapse After reaching all-time high in March 1984, the dollar index began a sharp decline that continued basically for about a period of 3 years. And if you look, even though the dollar is weakening today, the decline has been much, much less severe in terms of the decline it's seen over the last month or so. Oil prices between 1986 and 87 were rising steadily. However, oil prices have really not done a great deal in comparison in today's world, where we really sit in this close price activity around the $50 handle. And then looking at geopolitical concerns, that may be just one area where there is some similarities. Back in the mid to late 80s, it was all centered on the ending of the Cold War, whereas today obviously it's a lot more about North Korea and global fight against terrorism. So there's quite a few different things here. Again, I'm not going to go into everything, but I just thought it was an interesting document, and I've sent that out to you if you want to have a read. Just putting a bit of meat on the bones of the headlines that you're probably likely to see throughout this week, given this marks when around the crash happened 30 years ago. Alright, let's get down to the charts and have a look. And last night, lo and behold, no surprises, record highs, US equities again. S&P up 0.1% in terms of a session change, up just shy of 0.3 in the case of the Dow and Nasdaq 100. So equities this morning, not a great deal going on. Again, European earnings season hasn't got underway as yet. We're in the kind of midst of the US reporting season, but Europe will probably start picking up, I'd imagine, next week and the week after. And that might add a little bit of volatility to these European equity markets, which have otherwise been a fairly less volatile asset comparative to elsewhere, where bonds had a pretty decent day yesterday. Just reading a couple of market commentators this morning, because yesterday we had a pretty sharp rise in the bund, but if you look at it, in my mind, it's been rising really ever since the back end of last week, since that ECB source report on Bloomberg talking about the size of which they want to cut their tapering program. Some people looking at the comparative tone from the IMF meeting at the weekend, where Mario Draghi was a little bit more kind of slow and cautious, whereas Yellen was more of the language of, come on, let's get December done. This is what we're going to do. Markets need to reprice to that kind of fact. And so a little bit of divergence possibly just leading to a more dovish interpretation in terms of European fixed income markets. You could definitely kind of translate that also into the way the euro's performed. And the euro is underperforming once again this morning, because this time yesterday, of course, we were talking about the various political situations unfolding across Europe, whether it's Austria potentially forming a right-leaning coalition, or far-right leaning in terms of a coalition partner for Sebastian Kurz, and then the coalition complexity for Angela Merkel, having lost the Lower Saxony election at the weekend, and now you've got this ongoing Catalonian issue, which is probably going to rear its head again mid to late week, given the new deadline imposed by Rajoy is now Thursday. So there's enough there, I think, to explain maybe some people's short-term negativity for European assets and want to be more on a bias to short euro and long fixed income for the moment. The other thing to keep in mind with this euro-dollar pair trending lower is we did see a little bit of dollar movement last night. Let me just jump to this story here, but before I get on to that headline, basically there was a few reports in circulation yesterday talking about potential Fed candidates, and we've talked about Gary Cohn, we've talked about Jerome Powell, and obviously we'll have a talk about Janet Yellen in a second. But the one that was circulating on a Bloomberg report on Monday was John Taylor, who was said to have impressed Donald Trump. Now, if you were going to imply Taylor's rules in terms of how he sees interest rates as a byproduct of various measurements in the economy, then he would be seen as a more hawkish in that instance, and that rates should be higher, in which they currently are. And so the dollar did see a bit of a rally yesterday. late in the US session. However, it was then reversed because this story then followed, which was Donald Trump will be meeting with Federal Chair Janet Yellen on Thursday as part of his search for a new candidate for her position, according to sources with familiarity with the meeting that's been planned for later this week. So she's definitely not out of the running, it would seem, but it's still a bit of a toss-up. And actually, with John Taylor now into the fold, it's kind of gone back to a potential of several candidates rather than Jerome Powell, which was probably the favourite only about a week ago. We're starting to see a bit of a lead. So this, again, not really, I'd say, so much of an event where you're going to just trade it going forward from here. Certainly I'd be looking out for any headlines. The way to read it in terms of intraday reaction, if John Taylor or Kevin Walsh are believed to take the place of Janet Yellen, and if there was something concrete said of that fact, then you would expect the dollar to rally, you'd expect yields to have a bit of a pickup, so pressure, the US 10-year gold might come under some pressure in that situation. On the flip side, you have someone like Janet Yellen stay on, or Jerome Powell, and that's about as equivalent as you'll get to continuity. Cone would probably fit within that same group as well. So that's how you would divide the 5 candidates if you were looking at it from a trading point of view. All right, a few other things then. Headlines from overnight. Now, this did have a slight impact on the Aussie, but it's already been recovered, i.e. the currency did see some minor weakness when the RBA minutes came out. This is because Australia Central Bank reaffirmed growth is set to increase gradually. It's almost like the central banks are sharing their thesaurus in terms of the normalization process all being incredibly gradual, which is typically digested by the market to infer a very kind of a more dovish approach to tightening, if you like. But as I said, any movement that occurred in the Aussie, this is just minutes, so it is quite dated. The impact has not been sustained, and the move already been taken back. So I wouldn't really read too much into this. It's really just to keep you informed of what's happened overnight. Moving over to the UK and Brexit, obviously we have had Theresa May. It was well reported yesterday that she had gone to Brussels on Monday ahead of the EU summit, which is commencing on Thursday, because she wants to make some progress ahead of that so she can hopefully start to get a transitional deal secured, and then the more important conversations about trade. Yesterday, though, that did appear to break down. There was if you remember, we saw quite a sharp pop lower in the pound. That was this candlestick here, was in the early afternoon. That came after talk that actually the whole deal might have broken down. Not just a case of the negotiation, but the whole thing has come to a complete standstill. So this whole idea of Brexit occurring with no deal obviously is kind of the worst case scenario as far as the markets are concerned. This was when yesterday, if you remember, we saw a very quick kind of flash 50 pip move or so. We broke that low from earlier in the morning. We shot down to the low that was seen on Friday, broke through it later into the evening amid some of that dollar strength when those first Taylor reports started to circulate. We have recovered since, and we're back at pivot, and so just sub a 133 handle. I definitely think you still need to keep an eye on this situation. The latest state of play from this morning, Theresa May's attempt to unblock stalled talks by travelling to Brussels yielded little, with both sides issuing a statement that entrenched their previous stances. So it's kind of to be monitored. You could get a repeat of the type of headlines that you had yesterday, which did have some impact in the pound, but as we're going to see shortly, there are some big events for sterling today which are probably going to dominate over Brexit in the short term. We'll get to that in a minute. North Korea, as I said yesterday, it's almost dropped down the pecking order of market focus But it is something that I think that you guys need to be mindful of. Why? Because North Korea have warned that nuclear war could break out at any moment. Now, I know that sounds quite sensationalist, and it is, because I don't think that we're at the point nowhere near of nuclear war. But why are they saying this? This is because the US and South Korea are conducting military exercises over the course of this week. So whenever one side flexes its muscles, then it's pretty common for the other side to bite back pretty quickly. Just having a quick look, just noticed on my charts, oil here is having a bit of a breakout from the technical level of through pivot, but also through that late US high. There's also that kind of high that we saw back on, would have been late Thursday night last week. So just having a little test up here at $52 in crude, just while I'm delivering this briefing, so just keep an eye on that. Haven't seen anything just come down, or just seeing one headline: Iraqi forces take control of all oil fields operated by state-owned North Oil Company. So a couple of headlines still coming out. The Iraqi-Kurd situation has definitely been the focal point for crude markets over the last 48 hours or so since the weekend. Conflict within that region, which is obviously impacting one of the biggest producers within the OPEC group, is definitely influential for the price of oil. So that definitely needs to be monitored as we go through the coming days. Okay, let's have a quick look at the calendar then, and we can have a talk about the UK data coming up. That's because today you see at 9:30 UK CPI for the month of September. Now, just to recap a couple of points here, we'll be talking about this much more in terms of the setup and potential reactions and so forth, but let's just have a look at UK inflation, because if you remember the last reading we have, which was a measurement of August, we rose back to 2.9%, and if you go to 2.9, we last printed that back in May, or May's data of 2.9, and if you go all the way back, you're looking back to 2012 since we were last at 3% if we get to that measure. So we're at the peak of where we were. This would be kind of coming out the tail end of the sovereign crisis, kind of summer of 2013. Now, if you start looking even further back to encapsulate the kind of global financial crisis and where we were in inflationary conditions in the wake of that in 2010 and 11, we did run up to as high as in excess of 5% at one point. But the point being is that if we get 3%, we've not been at this level for, I guess, 4 to 5 years. Now, this is particularly interesting because it's this specific reason that the market has priced now overwhelmingly that the Bank of England will hike interest rates come the first week of November, irrespective of the political uncertainty and the other negativity or negatives that have been growing in the UK economy as a byproduct of these inflationary conditions. If we look at the core reading, the last reading was at 2.7. That was in fact at 2.7, the highest rate since December 2011. So if you're looking at the core reading, this is what's really important, because obviously you're strapping out the, right, or taking out the most volatile components, food and energy, so the underlying kind of sense of inflation is at its highest level, going all the way back to here on the chart. So today's going to be really critical to seal the fate of November hike from the Bank of England. And what is quite interesting is if we jump on the Bank of England website, you've got Dave Ramstein, Silvana Torreiro, and they're talking at the Treasury Select Committee appointment hearing. So this is just a hearing to do with, these are the two newest Monetary Policy Committee members, and so basically they just have a conversation with the Treasury Select Committee today about their appointment. More interestingly here is Mark Carney is also at the Treasury Select Committee hearing. So timing is key, because he's going to be speaking probably by the time he comes on, the data would have come out. And so Be interesting to see whether or not anyone questions him about this and about his intention of what might happen tomorrow. Because if, as you know, not tomorrow, but as in what the data might mean then for the early November decision making. So keep an eye out for any comments from Carney as well as we go through 9:15. I'd imagine this session will probably go on for a while. If you click on the Bank of England website, so this is where they have the schedule on the right hand side. If you go down to the bottom, you hit this in focus section, and here you are. This is the Parliamentary Live TV. So this is where I'll get a live feed, for example, if you want to listen to Carney live. So just copy that. I'll paste it in the chat room so you can see it now. Okay. Going back to the calendar. Aside from the UK figures, now if you'll look here, you'll notice that you do have CPI, core CPI, RPI, PPI input, output, core output. So there's a whole cluster of UK economic data. Whenever you see this, so this is more specifically for the newer guys, is try to put this into a weighted hierarchy of importance, i.e. out of these, let's call them 10, 12 different individual pieces of information, which is the one of which is going to carry the most overwhelming influence, and therefore for you to focus on as a trader when you're hearing the data come out. And I can quite comfortably say that it's the CPI report over the RPI, PPI breakdowns that's going to be much more important. Now don't get me wrong, some of these other numbers are particularly outlying, they might draw some attention, but I can tell you right now that that CPI number will account for, I would say, 90% of the way that the sterling currency will react in the immediate aftermath of the data coming out. Okay, so that's the UK numbers. They're coming out in half an hour, so we'll go into that in more detail shortly. I guess one final word of warning, just keep an eye on the pound about 15 minutes before the data comes out, because for the guys that have traded this enough, you'll know that there tends to be a little bit of pre-release movement indicative of someone in the market potentially knowing the numbers before the embargoed release. So just be mindful of that in the 15 minutes before 9:30. Looking further forward, you do have German ZEW economic sentiment. That's at 10 o'clock. Just having a look at that, we saw a very comfortable rebound in the previous data after the slight drop-off that we had in August. And so in terms of an expectation today for the headline reading, it's expected to improve again. So this is kind of just in fitting, I guess, with the general economic outlook that economists have had of the German economy, irrespective of some disruption. From an economic performance point of view, things still tracking along nicely as they are across much of mainland Europe at the moment. So keep an eye on ZEW. Again, this is the forward-looking soft sentiment survey of analysts and economists for their next 6-month horizon. You get Eurozone inflation, but these are final figures, so not going to see too much of a revision to that. So they're moving on into the afternoon, and the US afternoon pretty quiet in terms of economic data. Industrial production, cap utilization, probably your headline readings. And then, of course, you'll get your API crude oil inventories later on in the evening. Speaker-wise, as I said, Mark Carney, so you've got the link in the chat room if you want it. And then you've got Constancio speaking as well in about 25 minutes' time. And ECB's also speaking in a panel discussion later on in the morning as well. Earnings reports, Goldman Sachs, they'll be reporting pre-market as to, as imagine, MS. And then you've got IBM, which are typically aftermarket, but obviously large market capitalization, and one of the first within that sector to report, so that could be influential for aftermarket later on this evening. You've also got J&J as well. Alright, that's it. So I'm going to leave it at that. Let you guys get on. Any questions, I'll be available in the chat room throughout the day. But as I say, 9:30, the real focus for this morning. Alright, good luck.